In this section, I'm going to show you how to open trades in the platform, but first, let's quickly review some trade entry concepts. Buying an option, spread, or stock is easy to understand. We pay premium in the form of a debit to own the investment, and we can then sell it later to complete the trade. In all situations when we're buying to open, we want to pay a lower amount to open the trade than what we sell it for later. If we can achieve this, the difference will be profit. If I buy an option for $5 and sell it for $7 later, I would make $2 per share or $200 in real dollar terms. If I buy 100 shares of stock for $10,000 and sell the shares later for $12,000, I would make $2,000. As you can see, the best case scenario when we buy to open is realized when we can sell to close for a higher price later. The difference in price would result in profit. If we sell to close for a lower price than what we bought it for, we would realize a loss. Like you learned earlier in the course, if we buy an option for $2 and hold it to expiration, if the option is at the money or out of the money, we would realize a full loss of $2 per share or $200 in real dollar terms. At the end of the day, we want our option or stock that we buy to increase in price so we can sell it for a profit. With stock, this only results from an increase in the stock price. With long options or spreads, it could be a result of an increase in implied volatility or a favorable directional move without too much time passing. Selling an option, spread, or stock is a little more tricky as you've realized through the course. We collect premium in the form of a credit and assume the risk of the position. Later, we can buy the trade back to complete the transaction. In all situations where we are selling to open, we want to collect a higher credit on trade entry than the debit we pay to close the trade later. If we can achieve this, the difference will be profit. If I sell an option for $5 and buy it back later for $1, I would make $4 per share or $400 in real dollar terms. If I short 100 shares of stock for $10,000 and buy them back later for $9,000, I would make $1,000. In most premium selling strategies, the best case scenario when we sell to open is realized when we can buy to close for a lower price later. Just like buying to open, trades can go against us here as well. If we buy to close for a higher price than we sold the option or stock for initially, we would realize a loss. The difference between buying to open and selling to open in the options world is what happens when an option expires worthless. When someone buys an option and it expires worthless, that is the worst case scenario. When someone sells an option and it expires worthless, that is the best case scenario. At the end of the day, we want our option or stock that we sell to decrease in premium value so we can buy it back for a profit. With stock, this only results from a decrease in the stock's price. With short options or spreads, it could be a result of a decrease in implied volatility, a favorable directional move, or time passing. Remember, time passing or theta decay is an asset for short option sellers and a liability for long option buyers. Obtaining a high credit when selling premium helps us widen our break-evens, benefit from a contraction in IV, and have a high theta number. This is why we prefer to sell premium in high implied volatility and IV rank environments and get more conservative in low IV and IV rank environments. Regardless of the environment, we stick to the 45 day till expiration window for expiration cycles because we want to take advantage of increasing theta numbers that tend to accelerate around that time. This time frame also gives us ample time to be right if the trade goes against us quickly. This is especially true for debit trades, which can decay against us every day. Regardless of the strategy, we ensure that our risk and position size is in line with our risk tolerance and our directional risk is not too far from where we want it to be. Come take a journey with me into the Tastyworks platform and let's take a look at how these trades look in real time. Welcome to the Tasty Trade platform, where we can easily place, adjust, and close trades. You can see my watch list along the left side where I can see what's going on with stocks I'm interested in. Along the top, you can see that I've typed in CAT, which is Caterpillar's stock symbol. The stock details are listed to the right. It has an IV rank of 81.4, meaning the current IV percentage is on the higher end of the range CAT has seen over the past year, just like you learned earlier in the course. The stock price is currently around $130, and it is down 47 cents today. 5 million shares have traded today, so you know it's a very popular and liquid stock. Right now we're on the Trade tab, looking at the curve view, which will be very similar to the visual strategies you've seen in the course. I want to take advantage of the high IV CAT has with earnings coming up, so I decide to sell a strangle. Using the strategy menu, I can quickly load a strangle by clicking on the drop-down menu and selecting Short Strangle. As you can see, there are plenty of other strategies listed here too. I can click on Short to switch to Long, and vice versa. I select Short Strangle, and it spits out some strikes that I can easily adjust. I'm in the November cycle already, which is actually where I want to be. I think CAT will stay within a 20-point range for earnings, so I sell a 120 put and a 140 call to strangle the stock price. There's $3.44 of extrinsic value in this trade, which is what I'd sell it for. This is my max profit on the trade, and realized if the options expire worthless. The delta is pretty neutral at -6, as both the short put and short call offset each other, and I have a nice positive theta of $15 per day. That means if the stock price stays the same and there's no change in IV, this spread will decrease or decay by $15 per day. If I click on the Analysis tab in the upper left corner, the platform will show me the actual risk graph for the trade. I can zoom in and zoom out to scale the strategy to my screen, and I can analyze from there. You can see my upside break-even is 143.44, and my downside break-even is 116.56. Just like you learned earlier, my 344 credit boosts my break-even past my short strikes as the credit benefits me and can be used as a buffer against my losses. The probability of profit on this trade is nice and high at 74% because I'm covering such a wide range for the stock to move. Everything looks good to me, so I'll go ahead and click Review and Send for one last peek at the trade. This trade will reduce my buying power by $1,700, which is pretty typical for a naked option strategy on a $130 stock. If I'm filled at $3.44, that would result in a 20% potential return on capital if the trade expires worthless and fully profitable. I'm just dividing my max profit by the capital I have to put up to place the trade, which gives me about a 20% potential return on capital. Pretty good for a 25-day trade. Everything is good to go, so I click Send Order to route the order to the market for a fill. Going back to my Positions tab, I can see that the trade is now working at $3.44 and the market price is right around there. If I want to cancel the order, I can right-click on it and select Cancel. I can also change the price of my order by selecting Replace Order if the price drops, or if I'm not getting filled at my current price. That's it! Now you know how to place a trade on the platform using the curve view, which is nice and visual and very similar to the lessons in this course. Let's review. In the option and stock world, we can open a trade by either buying or selling something. If we buy to open, we pay a debit and we hope it increases in value. If we sell to open, we collect a credit and we hope it decreases in value. When buying an option, spread, or stock, our risk is typically defined at the debit paid. When selling an option or stock, our risk is typically undefined as we're collecting premium to assume the risk, which could be undefined. Theta decay works against option owners and for option sellers, which is why we typically sell premium. Even if we're buying an option or stock, we're selling an option against it to reduce our cost basis and help mitigate this negative decay. In the next section, you'll learn about closing trades and the reasons we may do so. Feel free to read more in the written content below, or watch this video again to ensure you're ready to proceed.